Okay, everybody. Hello and welcome to Investing with IBD, sponsored by MarketSmith. Today is February 26, 2020. I'm your host, Arusha Pierce, and with me today is Mike Webster.
Your favorite person, dude. Come
Exactly.
on. Not Mike Webster. My favorite person, Mike Webster.
Head of Market Strategy at IBD. And I guess I have to say this, but thanks for being here, Mike.
Yeah, all around good guy.
Oh.
You can go on. Come on. You can do it.
On today's podcast, we are going to talk about the current markets, how to grade your stocks, and
That's
we
gonna be
will
fun.
end with 3 current stocks.
Maybe 4.
And we probably have many, many interruptions from our favorite, Mike Webster. So, Mike, let's get into the current market because the current market has interrupted our fun that we've been having for the last 5 months here.
That's not cool,
right?
man.
I know. I mean, last week when we did the podcast, everything was nice. You know, we were in an uptrend, leading stocks were acting well, and it only took a week for everything to change. All of a sudden, the market realized that this coronavirus was maybe a little bit worse than people anticipated.
Look, it's an unknown.
Right.
Whenever you have an unknown, it just messes things up, right? And so as soon as the market figures out how to put a price tag on this, then we'll resume our uptrend. You know, Microsoft just warned after hours, so, that might, impact things in the morning. But sooner or later...
And do you know why the reasons why they warned? Was it just because it was
Yeah, it was
China
virus related,
and their
I
connection to
think it was
China?
their supply chain.
Okay.
I just, just read the blurb real fast. But that's going to happen. There's going to be more and more stocks are going to be releasing, warning. And some of them, it's just going to be excuses, right? Because, their business is having trouble. So blame it on the virus. But, the virus is going to have an impact.
I think Milli Vanilli wrote a song like that, right? Or is that this generation's Blame It on the Rain song, Blame It on the Virus?
Are you going to sing?
No,
Come on, man.
Sing.
You can do it. We'll just dub it in, like Milli Vanilli.
Okay.
But anyways, the point is that's why the market came down. Everybody knew that there was this virus, but it seemed like it was contained in China, and then it started spreading. Then all of a sudden, it's like, oh no! If this thing gets really bad, we just can't put a price tag on it. It's not that it's this horrible thing. It is horrible. People are dying. You set that part aside. You have to when you look at the market. But it's just that we don't know how, is it going to impact things by 5% on earnings? Some companies, it's going to benefit them. We're going to talk about that later,
Yes.
Like a Netflix or a Zoom.
Exactly.
Is going to help, maybe a ServiceNow. But, if you're in, airlines or hotels, I mean, you've got some serious, potential problems there, right?
Yep. And so I think this is... Yeah, this is a good reminder, at least for myself, why I love this system, the way we look at stocks, the way we look at the markets, because we're going over the field for the market, right? We're reading the charts. We know how stocks should behave in healthy markets or how markets should behave when they're acting healthy. And then all of a sudden, really at the end of last week, things started...
It was really on Thursday.
Yeah.
If you look at Thursday's action, so... We'll skip back to Wednesday. That's when we made new highs.
Yep.
Right? So at that point, you're saying, okay, now we're off to the races, and it looked like the NASDAQ was going to go straight up to 10,000. Because when you have round numbers, the market tends to just gravitate towards them like a magnet, right? And then as soon as the next day, when we came down and we undercut that low, and we undercut the low from a couple of days before that, I knew, okay, things are different now. It's fine. It was... I thought we were going to go in a kind of a sideways type of, maybe a couple weeks or something. But I knew we weren't going straight up to that 10,000 because that was the expectation breaker, but a mild one. There's not, they don't all have to be these major expectation breakers. So that was your first warning. And then the next day it got even worse. So that was on that Friday, and you came all the way into your 21 day. So that was a logical area for the market to stop and pause.
And this is on the NASDAQ.
On the NASDAQ. I always just look at the NASDAQ. And the reason for that is, it's important. The S&P is important. The New York Comp, the Dow, people like to look at. So it's important to see what other people are looking at. But if you just look at one index, it allows you to focus. Mm-hmm. And the NASDAQ is the one that really tracks our style better. So that's the only one I use for my market analysis, although I look at the other ones. So when we were at the 21, it was logical that, hey, we'll stop here.
Yes.
But we had this, uptrend, from the beginning of the move at 7,700 back at, if you look at October 3rd.
October, yeah. Wow.
Yeah. And then if you look at that line and match it up with, looks like the December 3rd low, that's where this entire trend up had been holding.
Right.
And so if we didn't hold there, then you knew we were going to have some, serious damage. And that's what happened. We just gapped through that on that news, and we stopped at the 50-day. So it seemed like, okay, now we're going to get some support there. And then that couldn't hold.
Yeah.
So it's like all bets are off at this point.
Yep. And it was yesterday, we started up a little bit higher.
Yeah.
Maybe for the first hour or two. And then all of a sudden started taking out the lows. Then it got really bad, and that's where it became much more obvious. And then today started up again, maybe we were up a percent and a half, right? Or was it? Did we got up to 2%?
I think we got up to 2%, but it was still an inside day. It looked like nothing on there. And at the start of yesterday, when I was looking at it, so the day after the gap down, I said, you know what? I've never seen this happen before where you have a gap down like that and then you just come back up.
Yes.
So I was very leery about it. I think we talked about it on IBD Live about that. And since then, I've been searching, and we have a decent precedent. Maybe we can look at that in a little bit, or
Yeah,
you
we
want
can
to
look at it pretty
now?
soon, yeah.
So that's in 1979. So let me pull it up.
Okay, well, before we we'll stick to the current market for 1 second. Another big thing that happened, and we've spoken about this on IBD Live, is vertical violation.
Yeah.
Right, and that was really, I guess, yesterday kind of confirmed that.
Yeah, that's a thing that Chris Gessel and Justin came up with, and that they're really the experts in that. But the concept is you fall fast and hard, and that's that's exactly what we did, and that's a reason to really back away from the market. So at this point, the market school rules that we have that I did with Justin and Charles Harris, that we are at a zero, meaning it's basically
cash.
100% cash. You're waiting for a follow-through day at this point. And so both ways, whether you look at it the way Chris and Justin look at it, or the way the market school rules are, or just normal IBD, you're
in a correction.
You're in a correction,
right.
And we could have hit the lows today, and we could go straight up from here. That's fine.
Yep.
Or we could go, and it could get a little bit worse.
Yep. And in the end, we don't want to predict. We'll just interpret. The first thing, let's make sure all the listeners know about this. Protect yourself, right? Protect your principal at this point. Go through it. Make sure you go through all of your holdings. Make sure they're above the 50-day. If they're not, if they're breaking the 50-day on heavy volume, or really, that's where you start raising cash. I mean, you should have raised cash over the last few days, because at least a number of my stocks forced me to.
Yeah, so that's a great point. I thought we were going to talk about it in the next segment, but it's worth talking about now. That if when the market gets under pressure like this, or gets in this situation, the first thing you do is you make sure that anything that you're at a loss on, you just get rid of it, because those 3% losses turn into 7% losses real fast. So just get rid of them. So look at your account. If you're down on it, you were wrong. Simple as that. That's going to raise cash right there. Then you start going and looking at the stocks that you had maybe just bought right before the market started coming down, and you're just up a little bit. Now, if those aren't great stocks, out they go too. So now you've raised even more cash. And then in the next segment, we're going to talk about how you rate stocks from an A to F. And then you're just going to sell off your C, D, and F stocks first, then your C stocks, then your B stocks. And then right now, you should only be holding your A and A plus stocks, because, we're 8% off our highs. That's an intermediate correction. Those happen all the time. Yep. We're in a major bull market. If you step back and look at the monthly chart, we're still in a major bull market. But we're going to have little bear markets along the way, intermediate corrections, 15, 16% off the highs. And if you stay fully invested during those times, you're going to get your head handed to you.
With our kind of stocks, right? If you're down 10% on the market, if you're down 50%, like you said, our stocks could be down they usually travel 3 times as fast. They could be down 45%.
Yeah.
At that. So, so you
they go
have
at
to
like
have rules.
Tesla, ludicrous speed.
Yes, exactly.
in both directions.
Right.
I like the other direction better, right?
It's much more fun the other direction.
So,
Okay.
but with the market, it doesn't mean you blow out everything. If you don't have any good stocks or you're not up on stocks, maybe you had taken a bunch of profits before you started off with some new stocks. You can be in cash right now.
Yeah.
There's nothing wrong with that.
Yep.
But if you have good quality stocks you want to hold on, maybe pare back the positions so you can sleep at night.
So let's go now to the precedent.
Okay.
And so we're looking on the NASDAQ. We had this really big sell-off, a vertical violation. And so now let's go to 1979. What time period?
Yeah, so the time frame I'm looking at is in October of 1979. So you can just do a change date to February of 1980, so you can kind of get a picture of what's going on. And so we were in this nice uptrend during that time frame. And I'll say, why are we looking at 1979? How is that relevant? Well, we're always looking for precedents in the market because what has happened in the past gives you a roadmap to what might happen now. And so with this, everything was moving along nicely. And look at those days. Back then, the NASDAQ was, very tiny spreads. And then all of a sudden you go into new high ground, just like what we did, right?
Yep.
So this was just like Wednesday where we poked it up into new high ground. Then that next little day, that was just like Thursday. So that was your mini expectation breaker. So that is, let's see.
That looks
October
like
8th. Wait, man, my eyes are bad. It looks like October 8th.
Okay.
So that was your warning sign, just like last Thursday. Then you had that big break right through your 21 day.
October 9th. Yep.
Yeah, right
and
through.
the 50 day.
Yeah, through your 50 day. And then it got worse. The next day was down even more. Then you had that little inside day. Kind of looks like today, right?
Yeah. So, well, we'll just describe this for most people who are probably. So
they're driving in their car. They're like, dude, where's the chart?
When you get home, because most of you are driving a car, working out, listening to this.
Look out, there's a car behind you.
When you get home, go to investors.com/podcast. You can see the video version. Maybe Mike will send it on Twitter.
Yeah, I'll definitely send it on Twitter.
Yeah. So we get hit hard. Then you don't get any kind of real bounce. It just kind of goes sideways for a little bit, and then you have another leg down.
And I could that would be very logical for things to play out right now is to take out the lows, and then it got its footing, and then it just went back to its old nature. So right now you're looking. Let's just go back to our current market, and it's. After looking at that, you can see how similar it was. We were just inching up. Now we have this unusual thing. So with stocks or with an index, you're looking for character changes.
Yep.
And my character has been known to change every once in a while. Every once in a while,
it's pretty consistent.
Consistent all over the place. I might throw a Bill accent in there. So, Arusha. Now, when the market comes down like this, you got to be really careful. And so. That's my attempt at Bill humor.
It's very good.
So when you have a gap down after a market that's been trading nice and tight, character change, you don't know what's going to happen. You wait for. So right now, what are we waiting for? It's simple. Follow through day.
Yeah. And in the end, you said the key word. Keep it simple. Right. Yep. That's the beauty of the system. We're looking for a fall today. The precedent. Go back, study that, because that gives you perspective too. These things, they look very, very scary, and they are scary. You want to protect yourself, but they come to an end too. So corrections are opportunities once you know how to protect yourself.
Absolutely.
And that's really the key here. So we are in a correction. Make sure you are protecting yourself, protect your portfolio, and raise some cash. So let's take a quick break, but when we return, we are going to talk about how Mike grades his stocks.
We're going back to school, baby.
Stay tuned. I'm here with Scott St. Clair, and Scott is one of the senior product coaches at MarketSmith. Now, Scott, we've both been doing this for a long time, and we know that investment research takes a lot of time. There's so many factors that you want to look into to try to figure out whether this is a stock to buy or not. Quarterly earnings, huge sales growth. Hey, are institutions buying it? The list goes on and on.
Yeah, it's a common question. I hear it all the time. I don't have time to do this work. So you don't have to spend that much time. If you have a tool like MarketSmith, we do a lot of that work for you. Right there on the chart, earnings, sales, group strength, institutional sponsorship, like you just mentioned.
Right.
It's all there in the chart, so it allows you to make a decision much easier.
Yeah, and the beauty is that we have in-house analysts that go through the SEC filings. They pull out those numbers, and they put it right on the MarketSmith chart, and all you have to do is analyze them.
Yeah, I couldn't imagine having to go to the SEC website and look at the income statement, et cetera. That sounds like a lot of work.
Yeah, and that would take hours and hours, and in that time, you can go through hundreds of stocks and find the best ones. So don't miss out on a big winner because you don't have enough time to research it. For more information, go to investors.com/podcast2020. Mike Webster is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Mike, let's go over, put on your professor hat. We're going to bring up Professor Mike on here.
Well, fair.
And so you've talked about this a bunch on IBD
Yeah.
Live, grading your stocks, right? You have some stocks graded A, other stocks F.
Yeah.
Walk us through your process of how you do this on a conceptual level, I think. Here.
Yeah. So, this came about, maybe over 15 years ago. It's probably like 2003, 2004. And I got a call from Bill. And he wasn't a happy camper at the time because I messed up and I sold. We just like what we had right now. The market sold off, and I sold what he felt was like my best stock. And he said, Mike, what's your best stock? Mm-hmm. And I'm like, and he's like, I'll give you one hint. It's not what you're up the most on. Click. And that was it. So I'm like, oh no, I don't want this phone call again.
Yeah. Did you ever figure out what stock he was talking about?
No, because I blew out a bunch of them, so I didn't know. So I'm like, okay, wait, I don't want, Bill is the best ever, right? And I don't want to make him mad, and I want to learn from this. So I'm like, okay, what is my best stock? So I started thinking about it. Well, what? It just seemed logical. At first, I was going to do it on a 1 to 10 scale, and then I, decided, I'm going to rate it with letters. Mm-hmm. So the next time we're under, pressure where the market's selling off, I'm going to get rid of my C stock, my B stock, and then try to hold my A stocks because that's what separated Bill from everyone else. He was able to hold a Syntex, an Amgen, Price Company, Pick and Save, list goes on. And along the way, he's trading all these other stocks, but somehow he's just holding this one stock and he's adding to it and adding to it. He would add to stocks a lot more than you would think. He would pyramiding in just a little bit at a time here and there, building his cushion of time as well as price from his cost. But he's a stud. So with that in mind, I wanted to figure out, what is my best stock? So I rate them, and I have it's a very systematic approach, but it is qualitative. So you go through, and your grade for a stock is going to be different than my grade. Probably not. You're not going to give something an F, and I give it an A. Right. But what you're looking at are both the fundamentals and the technicals and the sponsorship and the group. So you're looking at the whole picture of it, and where it is in its life cycle. Is this an IPO that just came out of an IPO base, or is this, Coca-Cola that you're trading that's been around for decades and doesn't really have anything new? Right. So why don't we start with one stock, and then we'll kind of walk through it.
So let's start off with Shopify.
Okay.
And so I've owned this stock for a while now, and so walk us through this. And so now we're looking on a weekly chart, right?
Yeah, I like to start off on monthlies and weeklies. Let's glance at the monthly first. Okay. And when I grade a stock, I start all stocks and I just give them an A. Doesn't matter. If I've got a $2 stock up in front of me, I'm giving it an A, and then I look at the $2 stock, it's immediately an F. I'm not even going to trade it, right? Right. So all stocks get an A. Then I'm looking for things that are bad about it to bring it down to an A minus, to a B plus, and so on. Okay. And then as I see good things, I raise it up. Okay. So, I'm not writing it down, I'm keeping it in my mind. So I'm looking at this monthly, and what I'm looking for is, has this stock been a big leader in the past? Yes. Now, it's clear that it has, and it's had some really nice moves in it. So it stays a solid A at this point, almost an A plus based off of that characteristic.
Okay.
If this had been in a huge downtrend, right? If we were looking at GE, for example, then that's going to go from an A down to a C or a D right away, just because of its history of being a laggard versus a leader. Now we move over to the weekly. And this is where you do most of your work. And let's not look at the chart first. Let's assume you've done your chart analysis and it's something that you want to grade, because you're not going to grade every stock.
Right.
And I start over in the left side of the chart and look at the fundamentals, and I just go straight down to make sure I don't miss anything. So in the left corner, we have the earnings, the annual earnings. What do you think about those?
They've been consistently growing. Right, went from 15 cents, negative 12 cents in 2016, 15, 38 cents, 46 cents, 23 cents. Not the greatest estimate right there. And then it jumped to 79 cents. So
yeah,
I think it's pretty solid.
It's got a defect, right? The defect was the fact that it's 46 cents, and if those estimates are right, going down to 23, which is a 50% down.
Yeah.
So now I'm going, okay, that's a pretty major defect if that number is correct.
Okay.
I'm making it from an A all the way down to a B. I skip through A minus and B plus. Then I kind of round back up after I look at the earnings block, and with that section, it's key. Bill would always look at it having at least 3 years in a row where the earnings are increasing. So like you said, minus 12, 15, 38, 46. So you have more than enough there.
Yep.
Then you go and you look at the ratings. So its EPS rating is a 35. Well, that's because it doesn't have the growth rate, because it's coming from negative to positive. So if you understand how the rating is calculated, you would give it a pass there. But
because you've already deducted it because of the annual.
Yeah. Well, the estimates aren't in the rating, but just knowing that it's coming from negative to positive, and that's what's throwing, that's what's throwing it off. I would imagine I have to look into it some more. So I'm going to give it a pass there. The group relative strength is solid in the 90s, so that it's staying an A. The SMR is a C, so that's a bit of an issue, right? So, and the accumulation distribution in C minus is okay. So I'm just going through each one of these things, and in my head, I'm adjusting. And at this point, forget that it's Shopify, and I love the story and all that stuff. Based off these raw numbers, it's going down to a B minus at this point. It has no earnings growth rate or stability.
ROE, the return on equity is only at 2%. That's pretty bad.
We're in the C category here. That's what a C looks like. So you have to be fair with these things, because the story is a big deal, concept is a big deal, but you're being, honest with yourself. And I don't spend a lot of time looking at most of the other stuff. The top 5 stocks in the group, that's key. That's a way to find other good names. So I would look at each one of those. The one thing in there that I do look at is the up-down volume. 1.6 is huge. Okay, Bill would look at anything under a 0.8 as being very bad.
Okay.
Anything at 1 and higher is good. 1.6 is massive.
That's 60% more up volume than down volume.
Yeah, over the last 50 days.
Right.
So that that makes it from, maybe it was at a C minus, now it's at a C or a C plus. It is a big, big important number. Then we go down further, and then we look in the quarterly block. And so let's look at the earnings first. Wow. These are some big numbers in here, 300%, we've got a negative, a plus 600, a plus 81. So that C plus is going now to a B minus or a B, because quarterly earnings are a big deal.
Yeah, for sure.
Right? Now we skip over to the sales. That's what this story is about.
Very consistent.
It's a sales. Any of the software plays, it's all about the sales.
But what's nice about this is they actually do have earnings, as opposed to a lot of the other cloud stocks.
Yeah,
they don't have the earnings yet, but they're very consistent on the sales.
Yeah, and so they are a special breed, and this is a window of time where we're looking at revenues. Now, the market might go back to the way it used to be and just focus on the earnings. So this here, they're being so high and so steady, this brings it up to an A minus.
Wow.
Do you see how we went around? Because if that was a plus 8 on the sales and a plus 2. This would be a D, and I would move on.
Okay.
But
Interesting.
this, you can have things that, check the box. But when something really surpasses it, and these are big numbers, big company. So we're at a, B plus, A minus.
Okay.
Now we go over to the chart, and we would, analyze this in detail. Let's see. So it's a later stage base according to pattern rec, but really if you look at that base that it formed in
2018.
2018. There's really a pattern in there where it undercut. There was a little cup with handle that broke out, failed, or almost broke out, failed, and undercut. So that reset, that's really a stage 1 there. Now we're coming out of a stage 2.
Yep.
We had that big move up. Now it's this first pullback to the 10-week line.
Mm-hmm.
So it looks normal.
It's acting well.
Right?
Yeah.
Let's look at the daily. So we're at a B plus, A minus. And, that reaction on the earnings, that was a huge move up.
Right.
But the fact that it closed at the lower half, not the lower half, really at the bottom of the bar, that's a bit concerning. Then it was going sideways, acting normally. I was looking to try to buy it, if it went over that little bit of resistance, but the market brought it down.
Right.
So the context of you always want to pay attention to what the market is doing to the stock. So with that in mind, that was so strong, I'd put this at a B plus, looking to buy it off of the bounce off the 50-day.
Okay. So that's the final grade for Shopify.
B plus, A minus.
Okay.
What would you give it?
No, I think that's fair. I mean, this is one of my top stocks, and so this is one of the ones that I'm still holding, and so I have it at really at the top of the list. But I'm also it's behaving really well, and also that story is so big too,
which is a big part of it that we didn't go into.
Exactly.
And it's if you didn't know the story, you read some IBD articles on it, you go to the company's website. We didn't have time to do it here, but you also look at sponsorship. All these things are going to move that letter grade around.
So, okay, let's do very quickly a bad stock or something that has a glow. So let's go to IIPR, which that one's been struggling. This is a REIT, but it was trading like a tech stock last year.
It was very high.
It was very high because they are buying a lot of the land for marijuana, and so it went on its monster move, and
it was not trading like a REIT.
It was not trading like a REIT at all. But it's gotten hit. It's 31% off the high. Just a quick summary of this one. Yeah.
So with this one is really about the context of it's already had its big move, and the position where it's in right now, looking at the weekly chart, it's not an ideal situation because you have that overhead resistance where it had broken out from that last base, ran up 48% within 3 weeks, looked great, and then fell down. So you got to imagine all those people who bought up there. If they still own the stock, as it gets up there, they're going to be selling into that.
Definitely.
So that itself, just the position of this, forget the numbers. The numbers are great on this. I mean, if you just look at the sales and the EPS, that's an A, solid A. There's nothing really wrong there. Mm-hmm. But the position of this makes it a C at best because, it's a low quality position to be in. Now, if it broke out and then formed another base, that base could be an A,
right?
But it's just having this overhead resistance is a huge problem for it. And in this environment, right, you're not buying anything. But if you're going to buy, let's say you're really tempted, you need to buy an A or an A plus stock. You're not touching a C stock.
Perfect. So having a system in place to prioritize your stocks will help you when you're deciding what stocks are your most important ones. Coming up next, we are going to discuss a number of ideas that are worth looking into. We'll be back. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button. You just click on it, and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. Mark Smith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. We are back with Mike Webster on Investing with IBD, which is sponsored by MarketSmith. Okay, Mike, let's get into 3 stocks, and we are going to dub this section.
What are we going to dub it? I have no idea.
We're going to stocks for the coronavirus.
Yes, this is the coronavirus. You stay at home with a corona and you use these stocks.
Exactly. So the first one, and this is what we're all going to do if hopefully it doesn't hit here too bad.
Yeah,
but
we shouldn't joke about
because it is obviously very serious. But Domino's Pizza.
Yeah.
Right.
So when if you are going to be trading, right, you want to look at what's going on in the market. Everyone's scared to it kind of reminds me a little bit of after 9/11 about how people wanted to stay at home, and,
right.
and then there were certain stocks that you're playing based off of that theme, and so now we have more to choose from. And so if this does, it's not why the stock has been running. Or gapped up, but in the back of your mind, you got to think, okay, if God forbid this turned into a real, situation in the U.S. like it is in China, what things would still work? And Domino's is one of them. I'm trading it right now. I bought it after the gap up.
And I do have shares of it too. This is the only stock that I bought in the last week or so because it reported earnings and it gapped up so high, and it just completely went against the larger market trend.
Yeah, when you have a big cap stock like this, it gaps up like that, and I think it's important to look at a monthly chart. So when you get home, if you're on the road watching this, or maybe you're working out watching it, when you get home, pull up a monthly chart, and this was a game changer type of move, and that's why you're willing to step up and buy it extended gapping up, because like we were talking about with the other stocks, this was a monster. This is what we call a long-term leader. It's a new product that we're coming out with probably this Friday. If
you get your act together.
Yeah, we're working hard trying to get that thing out, man. Justin, Chris, and I are working on it together. And anyways, this is what a long-term leader looks like. And in fact, we added it to that list where you've had this long move up, and really you want to focus your eyes on that relative strength and look at how that was performing against the market, when the market was doing its wiggles and wobbles, it was still, in this nice uptrend. Now, for the last year and a half, it's gone sideways. Right. So you wouldn't have it on that list at that point. At some point, it was just flattening out, and I thought it was probably going to roll over. That's what big movers do.
It's such a big move, right? It went from, if you look back at 2008, it went from $3 up to $300.
Yeah.
I mean, how much more could a Domino's Pizza? How much could a pizza company go?
Yeah, well, it's because it's the technology play too.
Right.
They came in. They're saying, okay, we're going to dominate this, this city, and we're going to have all these Domino's around. So whether it's Arusha or Mike buying this pizza, we're going to get it to them right away.
And we're gonna. And that was a big reason why I went on that monster run, because you could look on your phone and say, oh, they're putting in the oven.
Yeah.
Oh, it's going to the car. Oh, the car is on the way. So it was a really cool experience.
Yeah, and I recently ordered some, and looking at that, it was for a work day. I was like, wow, now I know that go out to the guard check now because the guy's out there.
Yeah.
It's very that's the N in canceling. It's pizza has been around forever, right? But now they're doing something new with it. They're figuring out a way to get it to you. Plus, they've improved their recipe. So
now let me just throw the new kind of thing, because that's been there. And what's interesting, and this is a really cool kind of case study. But so they have this huge technological advantage over other pizza companies, or over really every other takeout kind of restaurant. But then the playing field got leveled a little bit once Uber Eats came out, Grubhub, DoorDash, and now all these other companies could go and participate, and Domino's was losing its edge. Now, I'm still trying to figure out Domino's, why they jumped up. But one thing I read was if you have the Domino's app and you go and pick up the pizza, it recognizes when you're near this store, and when you walk in, it welcomes you right on the monitor.
You
Hey,
kidding
Mike.
me?
Hey, Mike. And they have the pizza, and they just hand it to you because they can see how far you are. So now they can see when you're coming to them.
Dude, I'm
that
doing
cool? Yeah.
doing
I should
that.
try that out,
That's going to be fun. We
Yeah.
should do that and film it. That would be cool. We'll put it on Twitter. So looking at this stock, let's look at it weekly now. You had this nice base, perfect looking cup with handle. And when you're looking at cups with handles, you want the handle to be proportionate to the length of the base. And so that's why, I think it's beautiful. It really is gorgeous, because if you just had a 2-week handle there, it would have been sufficient, but it's proportionate with it. And then you have this massive gap up, total game changer. It's a first stage base after it's been asleep for a while. And if you were to go through and rate all of this like we did with the other ones, you would give it a solid A. What's key about it is that earnings growth rate of 30 with a stability of 5. That's the one where you want the lower number is the better. That's saying that it's consistent. The only defect that I would say on here is, the estimates are a little bit low, 15%, 13%. But then you go down and look at the way it's growing. It's just not a rapid. It's not a ServiceNow or a Shopify where it really has these massive sales.
Right.
But it's a different, it's a pizza company. What do you expect, man? Yeah. So it has this big gap up. Let's go to the daily chart on it. And when that happened, you can buy some on that day. You don't buy a big position, and then you go and say, okay, if it takes out the highs of some area of resistance, then you're going to add to it.
Yep.
And so right now, if you drew a downtrend from that peak day, the gap up day, down to the high from yesterday on down, if it goes through there, I'll probably be adding to it, assuming that, the market firms up. But, this is also, you need to know your exit point. So if it gets much below 350, I'll probably exit it and then just come back to it.
Perfect. Yeah, so far it's been resisting the sell-off. It's acting well, and so definitely one to keep on the radar. So let's go to the second stock. And so now you've ordered your pizza, you're at home, and now you want to pull up Netflix and watch. Well, they have
What's
a lot
your favorite show on there?
on Netflix?
Yeah.
I don't really have. You know what I watch on Netflix? I watch a lot of the stand-up comedy shows.
I was watching the other night. I couldn't sleep. The Zach guy from Hangover.
Zach Galifianakis.
Yeah, I can't
your
remember.
character
Yeah.
in our three.
Exactly. He has this stand-up show that he did. Oh my God, from I think 2007. So it was like at the beginning of his career.
Yeah.
Oh my God, it's so funny. It's not something to watch when you're like trying to fall asleep because it's so good. But anyways, there's something for everyone on there, whether it's action, they've got their own stuff. With this one, again, let's start with the monthly chart. This is, has had these massive moves, but looking at the character of it, it does run into trouble. The bear market hit it way back when. Remember when they did the price increase that it got slammed on?
That's the Quickster thing too.
Yeah.
Are you talking way back then?
Yeah. So they had a few mishaps along the way, but it's got a very good management team. But it's been kind of ridden off recently because you have all the competition that's coming in, and of course, who's the big one that came in?
Yeah, Disney. Disney came out with Disney Plus.
Yeah,
which is pretty amazing because Disney's making new lows.
Yeah.
Right now, but Netflix is right near its new highs.
Exactly. Well, that's probably because of the parks. Like who wants to go to Disneyland right now? You don't know. True. With the virus thing. That's the last place you're going to go to. But their Disney Plus, the thought process was, well, who's going to get Netflix when it's cheaper with Disney and they've got this broad-based thing, especially anybody with little kids. But it's just this game changer where people are cutting the cord and now, they can live together. It's not like the iPhone situation where you're either going to do Android or you're going to do an iPhone. Right. You can have both. You can have your cake and eat it too.
Yep.
You can have your pizza and eat it too. So going to the weekly chart on this one, this kind of looks like, it reminds me of Amazon and Domino's in that it's been a sleeper for a while,
That's a good point.
while
Yep.
other stocks have gone up,
Yep.
which is a nice thing. So you've had all the software stocks had the big moves, the Shopifys, the Nows, you name it, that entire group, but these just kind of sat out, and at the same time, they the sales are still coming in there, and look at the earnings, the quarterly earnings. Went from a minus 29 to 65 to 333.
That's pretty
Dude,
cool.
that's acceleration, man. Ludicrous.
It's true. It is remarkable. It's right near the top of its week this week when the market is selling off. So it's going to start getting more relative strength, right?
Yeah.
Starting to get a little bit better there.
What's the best thing so if you were looking at this and everyone at home, just take a second and look at the fundamental information, and there should be something that jumps off the chart at you that is saying this isn't a B stock, this is an A stock because of this.
On a fundamental level? Or
fundamental level.
The 74% EPS growth rate?
Yeah, that's not where I'm looking. The estimates.
Well, 45%, 41%.
45 and 41
which
on
is
a
amazing.
big
That's amazing.
company.
But the reason why that didn't necessarily jump out at me is because they had that 333% quarterly thing.
Yeah.
So maybe it's just price anchoring or something like that. Or
price anchoring. Oh, there you go with your big words. Oh, let's get out the dictionary. Dude, my family wrote the dictionary. Look it up. So all the numbers are solid on there. Yeah, exactly. The EPS growth rate of 75. But if you looked at the earnings line, imagine an earnings line on it when it's ramping up like that.
Yes.
Sometimes it can mess with those numbers and inflate them a bit. But that's why you look at the estimates. So if this year was 45 and next year was 20, then I'd say, okay, that's normal. But 45 and then another 41, because you have to understand what analysts do. They lowball, and because they want, the company lowballs with their guidance, because the worst thing you can do is miss, right? You miss, you gap down 20%. And the analysts don't want to play into that. So if that's 41 for next year, if those numbers are right, really those analysts are thinking it's $10 a share or higher.
That's pretty incredible.
Yeah.
Because especially when you look at so 2015, 31 cents, then it was 43 cents, $1.25, $2.68, $4.13, $5.97, $8.43, and that $8.43 could be
$10
conservative, right? Yeah. So that is a really good point, and that's why you're the professor.
Okay. Well, there's another guy on Twitter that I call the professor, the Duckman 1717, something like that. Is the coolest dude. Really knows our stuff backwards and forwards. You can follow me on Twitter too. Webster 1971.
That dude's a little too dangerous.
No, he's really good. So anyways, and he loves Market Smith. So if we go to the daily chart, you could see that there was that cup with handle that it broke out of. And it's had this nice move up. And really where it's impressive is looking at the relative strength over the last couple days as the market has been getting hit. Now it's up into relatively new high ground. So it looks solid. And if the market has a follow through, this is going to be at the top of my shopping list.
Yeah. And today, first it finished up. And the volume increased too. And it was one of the higher volume days in the last few weeks, which is pretty remarkable too.
Yeah. Well, let's get to our last one.
Let's get to the last
Stop
stock,
rambling on.
I know, because Alexis is getting a little impatient here. So let's go to Zoom, ticker symbol ZM. And Zoom is a newer IPO. We use Zoom for IBD Live. We use Zoom all over for all of our meetings here. And obviously with the whole coronavirus scare going on, people are thinking, well, obviously in China, more people are forced to work from home. I mean, even for we have offices in China too, and they were having to work from home too.
Yeah, it's a great service, and so if you think back to like the Peter Lynch book, or his books that went up on Wall Street, and the other one, he was always talking about invest in what you know, look around you. Bill did the same thing. That's how he stumbled on Price Company and Pick and Save. And that's what Jim Cramer does too, talks about all the time. And so that's what all of us here, it's just kind of inbred that you look around. And we're on Zoom, like you said, every day. In fact, we're having meetings even with people in the same room. You have a Zoom meeting,
Right.
just because it's easier that way. You can share your screen. It's buggy. I don't really like the interface that much, but it's better than anything else that we've tried.
By far.
By
yeah,
far.
Yeah, I for the most part, I'm very, very happy with it.
Yeah, I think they'll just get better and better, but they're already light years ahead of some other stuff that I tried. So you have that as your backdrop, and then you look at the stock itself, and you're going, let's just look at the weekly. This has got this giant cup without handle at this point. Go and look at the numbers. Those are amazing numbers.
Yep.
The quarterly numbers, they were triple-digit sales. Now it's at 85. That's still huge, and the quarterly numbers are great. Now, what I was talking about with the estimates, this is more typical, where we have a huge estimate at 440,
Right.
and then it falls off to 11%. So,
which honestly
yeah.
is okay. I mean,
Yeah.
it's going from 5 cents in 2019 to an estimate of 27 cents and then 30 cents.
Yeah, they're probably lowballing, but you have this backdrop of this horrible virus thing that's going on, and this is a company that can benefit from it. And just think about it. It's a very sticky feature when companies start realizing, hey, we don't have to send that person out to China or to Italy or to where, even to New York from LA. They can just do a Zoom meeting, and they're just as productive. Now they don't have to pay for the hotel and the all, yada, yada,
Exactly.
all the stuff.
Yep.
So this is a way for them to get people to use it. Now let's go to the daily chart. This has been acting so strong, and I have a position in it.
I do have a position too. Yep.
And it's on a daily chart. It feels very extended, whereas on the weekly, you're right at that pivot. So just because of the backdrop with the general market, I'm not going to be adding to this, but this is one of the stocks that I classified as an A, so I'm trying to hold on to it. But it's a very squirrely. So it's what you can do is take your track price when you get home and go on MarketSmith and look at some of the big up days and the big down days and realize this is very volatile. And so if you're going to trade it, you probably want to trade it smaller size so you can handle the ups and downs of it.
Exactly, and they do have earnings coming up next week.
Yeah.
So you want to keep an eye on that. So there are a few ideas that are worth looking into and considering adding to your watch list. So thanks, Mike, for being here today. Wow, you're not even going to say anything.
Well, I was trying to shut up. No, you want me to go on? I'll tell you a Bill story. Well, no. Hey, dude, thanks for having me. It's always fun. And if you're listening to it, what you're missing is Arusha smiles at you the whole time. You just don't, you don't want to talk because you just want to look at him smile.
Well, that hasn't stopped you from talking, then.
That's true. Thanks, man.
That's it for this week on Investing with IBD, sponsored by MarketSmith. Next week, we are going to have Ross Gerber on. Ross is the co-founder and president and CEO of Gerber Kawasaki Wealth and Investment Management. He's a big fan of Tesla like Mike, and
we didn't get to talk
we're going to
about
have
that.
a lot of interesting things to say.
Want to do one more stock? Okay. We'll save it for next time.
Yeah, so stay tuned for Ross Gerber next week, okay? So thanks, everybody. That's it. I'm Arusha Paris, and thanks for listening.